Good afternoon, everybody, and welcome to today's Open to Export webinar about managing currency risk with Bibby Financial Services. My name is William Barnes-Graham, and I am Senior Content Editor at the Institute of Export and International Trade. Next slide, next please. Open to Export is a free online service helping small businesses get ready to sell overseas for our step-by-step articles and guides, regular webinars, our export action plan tool, and our quarterly competitions. You can find out about all of these on our website at www.opentoexport.com. Next slide, please. Open to Export is powered by the Institute of Export and International Trade, the UK's professional membership body for traders. Endorsed by the World Trade Organization and the International Chamber of Commerce as a small business champion, we offer a unique range of individual and business membership benefits, education and training catering for beginners through to master's degrees, and an always exciting and prestigious programme of events celebrating UK businesses' exporting achievements. Next slide, please. We will be running a live Q&A later in the session, and you can ask questions at any point using the question box on the control panel to the right-hand side of your screen. The general principle here is that we will ask questions that are relevant to the broad audience, so we won't be able to go into company specifics as such, but if you do have any specific questions, we can refer you to the Institute's technical helpline afterwards. Next slide, please. Today, we are extremely grateful to Bibby Financial Services for providing us with two great speakers in Daniel Ashley and Andrew Cook. And over to you guys, Daniel and Ashley.
Morning all, so thanks for joining us today. Oh no, afternoon, blimey, it's that time already. So we're basically just going to give you an overview today, current markets, certain outcomes that could happen within Brexit, different Brexit scenarios, and generally how to help mitigate some of the risk in trading these volatile markets that we're seeing at the moment. So my name is Daniel Ashley. I'm an FX dealer here at Bibby FX, and also with Andrew Cook as well. So Andrew is our FX Treasury Manager. He's had a wealth of experience in the industry, to say the least. So 29 years he spent at Bank of Tokyo, and we're very lucky to have him. So yeah, rest assured you're in safe hands today. So next slide, please. So exporters need FX partners. I've got a section here on no deal. I know it has been technically taken, well, not fully technically taken off the table in terms of House of Commons. They've taken it off, but it's not been enshrined in UK law. So if it were a no deal scenario, 22% of businesses will cut investment, 18% of businesses will cut recruitment, and 20% of businesses will move part, or if not all of their business, over to the EU. Now, I deal with a book of between 150, 160 different clients, a mixture of import and export as well. I'm already starting to see this across my book, whether clients are moving offices over to the EU or further afield, just to, well, basically prepare for any outcome in a sense. But a silver lining of that is that exports of goods and services from the UK increased from 2.3% month over month to a record high of 54.66 billion in January 2019. Now, a big part of why this has happened will be down to the value of the pound at the end of the day, because people who are importing from the Eurozone or importing from the US are getting a lot more value for their money from UK products. 55% of SMEs believe Brexit is damaging to the economy. I was quite surprised that this figure is not slightly higher, but I suppose exporters are bringing that down because at the end of the day, you guys should be getting more business coming through with where the pound is at the moment. And there are obviously positive steps that you can take, regardless of this uncertainty, which we'll delve into later on in the slide. So next slide, please. So ever so brief overview of us, just to give you a picture of who we are, who we deal with at Bibby FX. So we deal with all size businesses really, from small to large size businesses. You get your own dedicated trader with us, so someone who watches the markets for you, lets you know when rates might move in your favour, when might be a favourable time to exchange as well, and also give you access to spot and forward markets. The forward markets is something that we'll touch on later. to help mitigate some of the risk, and also access to market orders where you could put a strike rate into our system. So it basically means if you have a desired rate, you can put that into our system. If the market does move in that certain way, then it obviously strikes at that rate. And wider finance options available through obviously the Bibby Financial Services group, which we're a part of. So no further ado, let's go to the next slide, please. So just to give you a brief overview of what I'm seeing across my client base at the moment. The general feeling is that uncertainty is hindering business. I mean, some of my clients are saying that direct investment, new projects have slowed down due to their clients blaming Brexit. I think Brexit is becoming a very easy excuse for people to put orders on hold in a sense. Volatility in the market is leading people to hedge their FX exposure as well. So, I mean, we're seeing hedging definitely rise on our side, where people are putting forward contracts in place to mitigate some of the risks that's coming with trading these volatile markets at the moment. And obviously markets that are becoming increasingly harder to predict as well. And putting measures in place to preempt any outcome as well, like I touched on a moment ago, with moving offices over to the EU, just in case of any eventuality. I think because obviously I'm dealing with importers and exporters, I mean the general consensus is that we just need a decision to come out sooner rather than later. And this uncertainty, I know we're now obviously looking most likely an extension. That's almost been priced into the market now. It's not helping anyone at the moment. So next slide, please. So this is where I'm going to pass you over into the capable hands of Andy. So what he's going to do is just give you guys an overview of the fundamentals of the market, how they work, also where we could see certain eventualities, how certain eventualities could play out with Brexit, where we could see the rate going, and then I'll touch on how to help mitigate some of that risk towards the end of the slide.
Thank you, Dan, and good afternoon, everybody. Thanks for joining us. Firstly, today, what we're going to do is quickly look through certain factors that impact a currency's value, sort of in normal market conditions. Clearly, and in the news a lot recently, has been Brexit, which has the pound has been a slave to Brexit headlines. But under normal circumstances, there's a variety of factors that financial markets look at when establishing a currency's value. The FX market itself is generally accepted to be the most liquid market ever known. It operates pretty much 24/7, and the BIS, which is the central bank of central banks, so to speak, has estimated turnover to be well in excess of $5 trillion per day. So it's pretty busy. This slide, we're going to probably be a common theme here, is interest rates. So pretty much the most important factor markets look at is a country's interest rate. Sorry, a currency's strength or weakness is tied into that interest rate and the financial market's views on where interest rates are going to be going. As the slide suggests, higher interest rates generally lead to a stronger currency because you get a better return for holding that currency. Vice versa, lower interest rates lead generally to a weaker currency. There is a trade-off. Generally, the reason a country would have higher interest rates would be fighting inflation. Inflation generally devalues a currency. So obviously, whilst you're holding it and inflation is occurring, you're generally getting a devaluation, really. So you need to get a better return for holding the currency, and that would make markets buy the currency, hence strengthening it. If inflation obviously is very rampant, then it will override any return you get. So you would end up with a weak currency there. This is a common theme. This interest rates is a common theme. You'll hear that again today, I'm sure. But clearly there are other factors involved, macroeconomic, geopolitical events that lead to currency moves. So if we could move on to the next slide, please. A prime example being foreign direct investment. If we look at the slide, the example we've got there is a US company looking to buy a UK company. In order to complete that purchase, the US company would need to pay in sterling, so they would end up selling dollars and buying sterling to make this payment. If this is part of a common theme, for instance, or just the actual purchase itself is large enough, this can obviously impact both currencies. You would have a weaker dollar and a stronger pound. This type of flow in the markets is called real money. Real money is a longer term investment. It isn't quickly reversed. The sort of speculative flows, which are of a far shorter horizon time span, these are called fast money. This foreign direct investment is particularly relevant to the pound recently. In modern times, the UK has been a major recipient of these types of flows. Just look at UK utility companies, for example. They are generally in foreign hands these days. Brexit has, however, slowed this down, basically because of the uncertainty. And even though the weaker pound would obviously make purchasing UK company that much cheaper for an overseas point of view, Brexit is holding that type of flow back currently. Okay, if we could move on to the next slide, please. Okay, so there's a number of economic releases that we see that will the markets focus on to gauge currency strength. The first one we have there is GDP. This stands for Gross Domestic Product. This measures a country's overall output to gauge growth or otherwise. Current account. This indicates the overall flow of funds either in or out of a specific country. We get inflation reports, we get employment reports. Unemployment reports, there's many central banks that have a dual mandate, whereby they're not just there to target inflation, they also try to target employment levels. The US Fed, for example, has this type of dual mandate. We get trade balances, etc., etc. There's many. These are just a few highlights that I've picked out. The thing about most of these is that they're mainly backward-looking. They only show what's already occurred. We do get some economic data that is more forward-looking. We get confidence surveys. We also get economic forecasts from central banks. So markets look at these as well. In terms of the confidence surveys, the most closely watched by the financial markets is actually compiled by a company called Market, surprisingly enough. It's a large business intelligence consultancy, and they have three main surveys covering manufacturing, construction, and financial services. The latter one of those, the financial services, obviously has the largest impact on the pound, as the UK economy is so dependent on financial services. But they use all these different data points that are released to build a picture of a specific country's economic strength, both currently and going forward, and that will impact on the currency strength or weakness of that currency. Outside of these data releases, one of them, or the most important factor, would be market sentiment. It's the least tangible, but sentiment, along with the fact that FX markets are very forward-looking, play a big part in currency movement. A prime example of this would be looking at the pound actually on immediately after the referendum. So in 24 hours, I mean, the pound plummeted, basically in reaction to an event that was going to be 2 years ahead anyway. I mean, in fact, we're actually 2 years and 9 months currently, and we still don't know anymore really about what's going to happen. So sentiment is, as I say, it's very powerful. When it gets overwhelmingly one side of the market, be it bullish or bearish, markets tend to overlook anything that doesn't generally sort of tie in with that view. So you get a good trend. So that's one of the sayings in the market is the trend is your friend. So that just highlights that people will disregard factors that don't tie in with what they're hoping for. This does tend to lead to very overcrowded market positions. Everyone is either long or short, and when large speculative positions do build up, we do occasionally get a surprise that basically the markets can't ignore. So everybody that has spent several months, sometimes years, building up positions on one side of the market, will all attempt to exit those positions pretty much at the same time. So you get a very sharp currency move. The market loves its little adages. This one is actually known by up by the stairway, and down by the lift shaft. So just an example of a gradual rise followed by a sharp fall, or vice versa. Obviously, these releases aren't UK specific. They come from all over the world, and each country has its own releases. So I mean, obviously the level of sterling to the euro, for instance, is not just a reflection on the pound. It also reflects the strength or weakness of the euro. If all the data is fairly similar and the economies are moving it roughly in line, then you generally get a relatively stable exchange rate between the two. Obviously, if there's a slowdown in Europe at the same time as there's an economic boom in the UK, that's when you get significant moves. So you'd obviously see a stronger pound against the euro in those circumstances. As far as the data goes, as I say, there are many other factors, but these are some highlights. Sometimes, obviously, it's a political event or a shock event, like the financial crisis a decade ago, where sort of all of this economic stuff tends to go out the window, and we have a big re-evaluation. Currently, for us in the UK, obviously, we're going through one at the moment, and that is Brexit. So if we could move on to the next slide, please. This is, we don't actually have any numbers involved, but the big red line in the middle of that, the referendum day movement on the pound there, actually that just shows just a big one-day move. It did drop approximately 12% from the high to the low in the space of 24 hours. Moves like that in any currency are very rare. In an established currency, a major currency like the pound, they're nigh on unheard of. But it shows you that shocks do happen. If we were to draw this out a little bit, we would see that in the 6 months building up to the referendum, the pound had roughly averaged to about 142 against the dollar, 127, 128 level against the euro. And if we go back further, a year before the referendum was announced, the pound was trading at around 155 to the dollar and well above 140 to the euro. So markets were already pricing in the risk event, which was the referendum. And even though the outcome surprised everybody, or certainly most people, it shows that there was a movement down, then there was a sharp movement down on the actual event. Moving forward, obviously we still don't really know what sort of Brexit we're going to get, when we're going to get it, or even if we're going to get it. So we're going to have a quick look at certain scenarios that may occur going forward. Obviously the uncertainty has been stopping the pound from rallying back to previous levels. And despite, or even because of recent events in Parliament, that uncertainty is still prevailing. So if we could go on to the next slide, please. Okay, we've got a no-deal Brexit here. This is obviously, it is still technically possible. I know the Houses of Commons has voted to sort of a wish for it not to happen, but it's still enshrined in UK law that on the 29th of March we leave Brexit. Obviously today, Theresa May has asked the EU for an extension. That was literally this morning, and we've literally in the last hour or two had a certain response, or some response from the EU, which has not exactly welcomed it with open arms. So the pound has actually dropped in the last hour or so. It dropped around possibly just shy of 1% against both the dollar and the euro. But this is literally breaking news, so we're going to have to wait and see how that plays out. But if we do get a no-deal Brexit, then obviously we would see a pound drop. The pound is historically undervalued, so we do expect to see a sharp, sudden drop, but we're not expecting to see, you know, a decline like we saw on the day of the referendum. Any pound drop going forward would actually import inflation, and then we would see the Bank of England raising rates. So back to the interest rates, that would be what we think would underpin the pound. So we would get a drop, but we're not looking at historically low levels. In terms of the extension that Prime Minister May has asked for today, the markets would respond more kindly the longer the extension. That's just the way they are. We're currently pricing in a short extension. If one of the options open to May is for a longer one, then we would see the pound rallying on that. If we could go on to the next slide, please. Right, we've got here a second referendum. This kind of ties in to a possible general election. So a second referendum would ultimately take the pound higher, on the view that obviously we may not Brexit at all. It's unlikely, at least without a general election. Now, if we go on to the next slide, we see a general election bringing the pound lower. So it's a very tricky call. If we were to see a general election called, we expect initially a drop in the pound, but it would effectively be a proxy second referendum. Labour would run on the, we expect, on the manifesto of a second referendum. So even though historically markets don't generally favour a Labour government, it's not necessarily as straightforward as that, because if Labour are going to run on the manifesto of a second referendum, you've got that to buy the pound. So we basically sort of see what the polls suggest, even though polls are pretty unreliable these days, but that would be what the market took their lead from in that instance. If we could go on to the next one, please. Pardon me. Okay, so Theresa May does finally get her withdrawal agreement through Parliament. This is a sweet spot for the pound. The pound did actually rally a week or so back when this looked as though it could happen. Obviously, as things turned out, it didn't, and May has tried twice now and failed twice. But markets are pretty sanguine about all of this. Every time May sort of gets another knockback, it just increases the likelihood of an extension. As I say, we're seeing the first incarnation of that this morning, so we'll have to see how that goes. But if May were to get her withdrawal agreement through, or pretty much any withdrawal agreement through, to be fair, she could line up the EU with some concessions and get the ERG and the DUP on side, and then get the Speaker to allow her to actually present it to Parliament, and then actually win in Parliament. Then the pound would rally pretty strongly, we suspect. Going back to the 142 level prior to the referendum, that 6-month average, we expect that would be the first kind of target. Maybe consolidate around there for a while, but then we do expect the pound to go up again from there. In this scenario, again, we would see further interest rate rises. The Bank of England are very keen to raise rates. Brexit has been stopping them. So once Brexit is resolved, we think either way we should see interest rate rises, which will either help boost the pound or certainly stop it from dropping a great deal further. Finally, just let's just look at dollars and euros as they're the main trading partners. In the event of a no deal, we would expect to see a slightly more pronounced reaction against the dollar, because despite all you may read in the press, a no deal Brexit is going to impact the UK, no doubt, but also the EU. So we see the EU economy, which is already suffering a slowdown, and the euro has been weakening on the markets because of it. That would be another blow to the EU economy as well. So whilst we would probably see a short-term drop, we don't expect to see a huge reaction against the euro, but possibly larger against the dollar. Okay, so that's really it from me. I'll pass you back to Daniel now. He will advise you on what we can do for you to help reduce the currency risk. So back to Daniel, and thank you for listening.
Thanks, Dan. It's really interesting actually seeing seeing the shift that we've seen recently, or even going through those slides. We moved from more of a data-driven market to more of a politically driven market. I mean, it wasn't too long ago before Brexit, where inflation figures came out or GDP figures came out, had a massive impact on the market. But now that's all being overweighed by everything that's going on with Brexit at the moment. So really seeing quite a large shift on that side. But if we pop to the next slide, please, that would be perfect. So obviously, the reason you guys are here, you want to know how you can help anyway mitigate some of the risk that comes with trading these markets at the moment. So one of the ways in which you could do that is by utilising forward contracts. So forward contracts are where you can reserve a rate for a certain period of time and for a certain amount of currency. And it just lets you know exactly where you stand, but I'll delve into this a little bit further if we go to the next slide. So this is a long shot graph from Brexit Day up until a few weeks ago. So I mean, we had some of our import clients who locked in their currency in the high 140s. So I mean, they were still achieving the high 140s from their forward contracts, even when the rates were down in the 125s, in the 120 sort of arena. On the flip side, like most of you guys being exporters, we did have some of our export clients as well, who managed to lock in their currency on the dollar side, when it's down in the low 120s. So even when the markets were building up to that sort of 135 sort of level, they were still achieving those 120s. Obviously, that is an absolute best case scenario. It's I mean, hindsight's a wonderful thing. It is. I mean, forward contracts are a wonderful tool. We can't claim to know, obviously, when is the best time to get into the market, but if you could time it right, then they can work extremely effectively. So next slide, please. So with forward contracts, the nice thing is it doesn't tie up. It doesn't tie up any of your currency. You don't have to put any deposits down to put them in place, so it doesn't tie up any cash flow. It would only come up to the point where you would actually draw down from that contract. That would be obviously when you would settle. You can go up to 12 months as well, so you can hedge part of your exposure for 12 months, or in certain cases even further, and it ranges really from a week really to 12 months. So you can cover as far as that really. It generally helps mitigate some of the risk of the currency markets. I mean, my clients play it in different ways. Some of my clients like to lock in the whole of their exposure when they're receiving an invoice, or they know that they've got currency coming in from the Eurozone or the US, because they don't want to play the markets. They know that they can lock it in above their costing level, and they're securing their profit in a sense and not leaving anything to chance. Although some of my other clients like to maybe do a partial exposure where they might tie up 30, 40, 50, whatever percentage it might be of their currency on a forward, and then that leaves them the opportunity to obviously then gain from some upside risk if we do see the market move in that way. But obviously if the markets do move down as well, at least they have that protection there just in case of that eventuality. And obviously, as Andy touched on, we've seen some pretty large market movements, to say the least, over recent times. And I mean, it was just a week ago, wasn't it? We saw about 300 or 400 point movement on the dollar in the space of a few hours. So it really can make a massive difference to your bottom line. And at the end of the day, the last thing you want is to getting less pounds back for the euros that you're receiving in, or the dollars that you might have expected. And this says there, it helps you know exactly where you stand for your exports, so exactly how much you're going to be getting back from that. So thank you for listening to us. I believe that is us in terms of the presentation. If we can go to the next slide though, please. So we'd love to take any of your questions. I have put our number up there as well. That is my direct dial on the desk. If any of you guys have any questions or just want to run over anything that we haven't cleared up for you or anything on those lines, we'd love to hear from you. Please don't hesitate to get in contact.
Great, thank you, Daniel. Yeah. Thank you, Daniel. Thank you, Andrew. Some really good advice and really interesting context there as well, particularly around just how much it did drop on Brexit referendum day. So yeah, we are now going to open the floor for questions, and you can ask questions using the control panel on the right-hand side of your screen, so please feel free to do so. First question I'm going to ask is from Candice. She asks, is it necessary to open a Euro account to handle importing and exporting with the EU at present?
Yeah, hi there. It's Andy again. As a BFX client, at least, and I'm sure elsewhere, you don't have to open a Euro bank account. We can take receipt of funds. If you're receiving funds in, we can take receipt of those. They're held in a secure account, obviously in your name, and then you are free to exchange them as and when you wish. We can even hold on to them, if that's what you prefer. In terms of if you wish to then pay away the foreign funds, we can pay direct to a supplier, or as I say, we can exchange back into sterling and return to your company bank account. So there is an element, obviously, the question we saw as actually mentioned importing and exporting. Obviously, if you're doing both, then you get a natural hedge on your currency. But it isn't necessary. Ultimately, it can be handled by an exchange company like ourselves. I hope that answers your question.
No, yeah, thank you. Another question, I think this one with you, Andrew, and it's obviously you're noting about the potential impacts of different situations in phase one of the UK withdrawal agreement. There's obviously still the whole second part of this negotiation to go after Theresa May's withdrawal agreement goes through, which is the trade part of it, future trading relationship. Have you guys looked into what potential impacts there may be in terms of how those talks go on the strength of the pound?
In terms of the trade agreement with the EU, well, obviously nobody knows exactly how that'll go. We kind of the bigger picture would be that the EU exports to us, we export to the EU. We don't see too many barriers ultimately being put in place. Again, as Brexit has largely impacted the pound, if that is the way it transpires, then we would probably see some pound benefits to that scenario. It's very difficult to predict how these things will happen, but broad strokes would say that the EU's economy is as reliant on us as ours is on theirs. So any barriers to trade ultimately are going to be bad on both parties. So we would expect only minimal changes, going forward. It may not happen instantly, but going forward we would expect. There's no point in putting restrictions in place that hurt everyone. So we wouldn't expect to see much in that regard.
Okay, cool, thank you. And you've had a question just in from Mikola, who's asking about the costs of using forward contracts. So she asks, how much does a service of a forward contract cost, for instance, if it's an exporting contract of, say, 150k? Do you want to clarify on that?
So it all depends on the different currencies that you're using, really. At the end of the day, it depends what 4 points do get charged. Because of the interest rate differentials and the different currencies that you're dealing with, it depends how many points will be passed on to us via our banking partners, which will basically help us cost the contract. So it would vary. I mean, if you would like to contact us directly, we'll be more than happy to give a quote. That's absolutely fine. We just have to obviously double check on the point side, because like mentioned, if you are dealing with, say, for example, a euro dollar forward, the points are completely different as to whether you're dealing with a dollar sterling forward. It all depends on the interest rates in basically both of the currencies that you're using. But yeah, more than happy to hand out any quotes if you'd like to. You give us a call, more than happy to help out.
Excellent, thank you. And we've had a question in advance from Jean or John asking if going to a trade show, how can one best give a kind of price and transport costs in US dollars when we have to be given well in advance?
Yeah, no, of course. So obviously with, well, I presume you're talking 6, maybe 12 months in advance. That touches on what I finished the slides on there, really, with 4 contracts. You can basically lock in that cost ahead of time. So you can basically lock in a 4 contract for 6 months for exactly the amount of dollars that you do need. At the end of the day, that lets you know where you stand, in a sense. Lets you know exactly how much pounds you're going to be using for your trade show, which is costing in dollars. So that can go anywhere up to 12 months in advance, and it's just security in a sense. So it leaves you with peace of mind in terms of you know exactly how much you're having to pay at the end of the day once you do eventually go to that trade show.
Great, thank you. And another question we had in from Rim, and they ask, what about sanctions risk? So US banks have kind of stopped payments if connected to embargoed countries of Russia. So kind of how should you factor in risk of sanctions and all that sort of side of things?
Well, in terms of payments that we do actually to make for our clients, every payment we make actually is screened for sanctions. It goes through an up-to-date list of all blacklisted countries and people and corporations. So every payment goes through these compliance checks. There's a big database that has all of these things on, which is live. And all of our payments are checked to make sure that they don't contravene any US sanctions, UN sanctions, WTO sanctions, whatever it may be. And the payments are only released once this procedure is completed. So we can't actually say in advance what sanctions might come in, but obviously we do comply. We have to comply to any that are actually currently in place. If that answers the question.
I hope so, and if not, then please do follow up with us afterwards.
Sure.
A question just in from Grace, and Grace makes foreign payments in various currencies. Should she make one forward contract per currency? And she also asks, is there any minimum amounts for setting a foreign contract?
In terms of forward contracts, I mean, there is no minimum as such. But we normally wouldn't book it for anything sort of under 20,000. I would have thought, although it is a case by case basis. To be honest, anything over 10,000, I would have thought. But yeah, again, case by case. And it's entirely up to her. She wants to cover her risk on each currency. At the end of the day, it depends whether she wants to lock in the whole of her exposure or lock in part of her exposure. I mean, like I touched on earlier. I work with my clients in different ways, so I would say probably a 50-50 split in all honesty, in terms of people who like to hedge their risk, whether it's doing a part of a contract, so doing 30, 40, 50%, wherever it might be, but I also do have clients who do the full amount as well. But yeah, you can do it in a multitude of currencies. So you can have 4 contracts out in euros, dollars, Australian dollars, whatever it might be. So it doesn't. You're not just limited to one currency in a sense. And it would only basically be at the time of drawdown when you actually need to utilise those funds that you booked on forward, and that would be obviously when you actually draw down for the contract, and that would be when you settle.
Okay, great. And one other question in from Adam. He's asked about payments to India, and if they have suppliers there, but there's no FX trade, just foreign payments. So he's asking, do you facilitate payments to India? Presumably do, but can you give a bit of context about the Indian currency, perhaps?
For us, it's a really tricky one. I think I'm going to help Andy answer this one as well. But we can't actually send out INR, can we, at the moment? So
the thing with INR is that it's purely a trade-based thing. We would need extensive documentation in order to make an INR payment. virtually the whole trade would have to be documented, and that has to go hand in hand with the payment. The issue that most people, in our industry suffer is that if for whatever reason those funds do get returned, and it does happen with international payments, if the T isn't dotted correctly or something along those lines, and payments do get returned, we then suffer quite a big penalty in terms of what we do with those funds. Obviously, we could attempt to resend them, but we do actually get a significant reduction in what we get back. So whilst we can make INR payments, it's something that is particularly fraught just because of the country's regulations. So we do have to do a lot of legwork in order to make INR payments, but it is something that can be done. There's a lot of risk involved for all parties ultimately, just because of the currency restrictions in place. I hope that helps.
I think so, yeah. If not, we can follow that up afterwards. And I had one other question in. It's a bit of a speculative one, but do you guys have any views on Bitcoin or cryptocurrencies? Is that something you can see come into play at all in terms of this area?
It's ironically enough, we get asked this quite a lot, don't we? The Bitcoin and cryptocurrencies in general do fascinate me, to say the least. But in terms of the wider Bibby Financial Services and the FX position on it at the moment, I mean, it's not something that we're going to delve into or give any sort of speculative views on either. It's something we do have our eye on as a group, and we'll keep an eye on it. But it's not something that we really delve into, that we're going into at the moment. Put it that way.
Yeah, and just to add to that, in terms of Bitcoin, the technology behind it, the blockchain, is certainly something that is going to become very, very widely used, I think, in all international transactions. In terms of the individual currency or cryptocurrency involved, you see in the news so often of exchanges going bust, etc., etc. So, and there's literally hundreds and thousands of individual cryptocurrencies. So, currently we wouldn't involve or engage in one purely because we simply have the cryptocurrency markets can move 10, 15, 20%, a day, and regularly do. I mentioned earlier about sterling and a 12% move lower from the highs to the lows on referendum day being literally unheard of. That sort of movement is commonplace in cryptocurrencies, and consequently it's such a gamble for anyone to actually make a trade payment, because you could be losing 20% in a matter of hours. So as things stand, and I think probably going forward for some way, we wouldn't be touching cryptocurrencies as a form of payment. And again, I hope that helps.
Yeah, no, I think there's like just to echo what Andy said, really. I mean, there's definitely some value in the way that what sort of backs up cryptocurrency, which is the technology behind it. But yeah, it's not something that we'll be delving into at the moment, anyhow.
Okay. Well, one for the future then. Maybe that's one for a webinar in 2 or 3 years' time, perhaps. Anyway, on that note, I think it's probably time for us to wrap up. So thank you once again to Daniel and Andrew for answering the questions and for your presentations.
Thanks, guys. Thanks for joining.
Thank you.
Cool, thank you. Next slide, please. So Brexit uncertainty remains rife, but we really do suggest that exporting businesses prepare for all eventualities still. Completing customs declarations is something that you will likely have to do for the first time after Brexit if you sell into Europe. It's also something you already need to do to export to markets beyond the EU. The Institute of Exports and International Trade provides several online and offline courses to help you learn how to do fundamental export tasks like this. and you now have just over 2 weeks left to apply for government funding for many of these customs-related courses. For more information about the training and the grant funding and all the activities at the Institute of Exports, please go to export.org.uk. Next slide, please. We're also running our spring competition for SMEs who are newer to export. This is a great chance to win £3,000 cash towards your export plans. All you need to do is complete your online export action plan and send it to us by April 12th. It's a worthwhile exercise for any exporter to do anyway, and more information can be found on the Open to Export website at opentoexport.com. Next slide, please. Our next webinar will help you to understand how free trade agreements actually work for exporters and importers, discussing things like preferential duty rates, tariff codes, rules of origin, and many more export essentials that will become increasingly discussed when Brexit talks eventually, if ever, move on to the next phase. This will take place on April 11th, and you can find sign-up details to this at opentoexport.com/webinars, where you will also find a recording of this webinar shortly. As always, please do take our exit survey to let us know what you thought of today's webinar and to give us any suggestions for improvements or future topics. Have a great rest of the day, and thank you.